Hey everyone. So I just finished one of my clients' financial plans and I wanted to share with you what that looks like. My client is a high income earner, and just like a lot of high income earners out there, they were wondering, her and her husband were wondering, how can they reduce their overall tax bill? Okay, so they could put away more for their future because they were feeling like they may not be doing enough for their retirement. They don't know what they're on track for. And sometimes they just don't know where their money is going because, yeah, sure, like they make a lot of money, but they get taxed a lot. And I know, like, if you're a high income earner out there, you're probably wondering the same thing. It's like, yeah, I make a lot of money, but where the hell is it going? Is it probably is taxes, right? But sometimes you may not feel like the need to keep track because you're maybe having constant excess cash flow in your checkings account, right? So in this video, what I'm going to do is I'm going to walk you through the client's current financial situation to see what they're on track for and the strategies that they can implement now to make sure that they're reducing their taxes and that they're putting away enough money for their retirement and to make sure their finances are optimized. And what that means is making sure that they're not having massive cash balances sitting around doing nothing. So if you have a boatload of cash sitting around in a savings account, it's losing money to inflation. Okay, so that's not very optimal. You want to make sure every dollar is optimized and working for you. And if they have debt, that they're financing or paying it off in the most efficient way. So meaning their debt repayment strategy is optimized and that they're paying the lowest interest as possible. Okay, the key here is to keep as much money in your pocket and their pocket. Okay, that's what everyone's financial goal should be, right? Is to keep as much money for yourself. So just a quick profile on Betty and Hank. So of course I changed their names for confidentiality purposes. So Betty makes roughly 165K per year in salaried employment income. Okay, and this includes her annual bonus. Her husband Frank owns a business, so he pays himself 50K a year in dividends. Okay, so that's great what they're doing because if you have a business and you find yourself you're paying a lot in taxes, there's a company structuring issue. Okay, so so Frank paying himself $50,000 in dividends is putting him in a very, very low tax bracket, which is great. They don't have kids. Betty is 40 years old and Frank is 50 years old. So what's happening right now is that Betty just started a 4% match group RSP at work. So she just started this, and before she would just save up money throughout the year, make lump sum deposits towards during RSP season. But she doesn't know if this is enough. She just randomly puts whatever amount she feels like towards her RSPs before the deadline. Each person is contributing $5,000 towards their TFSAs. Okay, they each manage it on their own. They own a house. Okay, there's a $430,000 mortgage on it. That's the balance, and the house is worth roughly $800,000. They have a car loan that they got a new car recently, so it's around $40,000, and they're financing it at 5%. And they're also paying back into their home buyers plan in the RSPs. Okay, they took money out of their RSPs to use for the down payment for their house that they bought around almost 4 years ago. So any contributions that they're making towards the RSP, there's going to be a portion of it going back into paying back into the whole first-time home buyers plan. So this is their summary, their net worth summary as it stands. They have just over $1 million in assets. Okay, and that includes their home. So of that, about $200,000 of it are liquid. Okay, so that's a combination of their cash and stocks. Their car, and it also includes their car. So let's just say it's worth around $30,000. Okay, so you net out the liabilities. Okay, that's the mortgage and the car loan. They don't have any other debts, and they have a net worth of about $500,000. Okay, so not bad. It looks good right now. Okay, so nothing wrong with this picture. They have a $500,000 net worth. So what they're doing right now, okay, this is their current strategy, is, as I mentioned, Betty's work just started a group RSP program where she contributes 4% of her base salary, okay, and the employer matches that 100%. So it's a 4% match from her employer. She's putting $5,000 per year in her TFSAs, and roughly she's been putting away $1,500 per month towards her RSPs. So she'll put that away in a savings account, and then at the end of the year, she'll just dump that into her RSPs. And as for Frank, he's putting around $5,000 per year in his TFSAs, and then he's paying back the minimum, okay, of $2,300 per year towards his RSP. So no tax deductions here. This is a mandatory repayment he has to make towards his RSPs because of that first-time home buyer's plan. So, and they also make random payments on their mortgage each year, okay, say around $6,000 per year. And in doing all of this, I'm going to show you what they're going to be on track for. Okay, but right now their goal is to, okay, based on their current strategy and their financial picture right now, what their goal right now is to allocate and optimize their cash flow so that every dollar is not wasted, and to know where their money is going, and to reduce income taxes, because Betty is in a very high income tax bracket. Okay, she is on track to pay over $1 million in taxes in the next 20 years. Okay, think about how crazy that is. Okay, that's like the cost of a house in Toronto. Okay, but that's all going towards taxes. And of course, they want to allocate more money towards their retirement goals and making sure that they won't run out of money in retirement. Okay, so that's their fear right now. They don't even know what they're on track for, but I'm going to show you what they're on track for. But of course, this is it's a common fear amongst a lot of Canadians. So what they're on track for in terms of the retirement is they will meet their goal. They're going to get their retirement goal will be covered by 76%. Okay, so that means that at some point they are going to fall short. And in this graph where the red is the shortfall, it's going to show up around here, okay, in around 2062. So not very desirable. The last thing you want to do in retirement is to, just going to get my pointer here. Last thing you want to do is to run out of money when you're not even working, when you're not working anymore, right? So as you can see, what's going to start, basically all their investment accounts are going to be drawn down just after 2060. And what's going to happen is they're going to be relying on government pension, okay, CPP and OAS. Because remember, none of them have a defined benefit plan where their employer, where you pay into a pension and then you get payments forever, okay, until you die. So they don't have that. So this is why it's important to make sure that they have enough money stashed away on their own, because basically they're on their own right now. And Betty's group RSP is it's an RSP where it's a defined contribution plan, but so basically once everything is drawn down, that's it. Okay, so right here they're gonna fall short on their income needs around 2062. That's what they're currently on track for. And also I just want to point out that because Frank is not contributing to his RSPs at this point, because he's self-employed, pays himself a dividend, what ends up happening is by the time Frank retires, okay, Betty's going to have almost $1.2 million in investment assets, whereas Frank will have almost $300,000. Okay, it's uneven, and we don't want that. No, you don't want that, because what ends up happening is at some point, Frank is going to exhaust his account, and all the money is going to come from Betty's investment accounts, which means Betty is going to be fully taxed. Okay, it's going to put her into a very, very high tax bracket. So she's going to be paying a lot of taxes again. So when you're planning out your retirement with your partner, you want to make sure that both of you have relatively even account so that you're going to be, instead of one person being in a very, very high income tax bracket, one being in a very low tax bracket, one person is going to be paying a lot of taxes. What you want to do is even it out so that you're both in a relatively lowish tax bracket. Okay. And at this point, by the time people realize this, it's too late. They don't really have a lot of options. So that's why planning ahead is very important in this aspect. So these are the opportunities that I see. There's a lot of room for more RSP contributions. That's going to reduce Betty's taxes. I'm not going to talk about their portfolios in depth, okay, but all I can say is some restructuring is required. They're paying a lot of fees, okay. These are, portfolio killers. Talk about them in other videos, but I'm not going to talk about it today. And there's cash sitting in TFSAs, okay, so not very optimal. Don't waste your TFSA room and have it sit in cash, okay? So that's getting eroded by inflation. There's opportunity to refinance, okay, because they have a car loan, okay, at 5%. So they can easily pay a lower interest amount. And in doing so, in refinancing, they can free up cash flow. Okay, so they're paying around $500, almost $600 per month in their car payments. Okay, so they can reduce that. They can free up that cash flow. And what they can do is, because they have a mortgage, okay, they can turn bad debt to good debt. Okay, that's part of the refinancing strategy. Okay, this is also a rich people strategy. Okay, to get more tax deductions. I'm not going to go into specific nitty-gritty details because I have to explain this. It's going to be in a completely different video. Okay, so what you could do is, when you have a mortgage, you can turn bad debt into good debt, whether it's credit card debt, line of credit, anything. Okay, and you will get tax deductions from that. And then, of course, any uneven RSP contributions between Betty and Frank, I talked about that right here. We are going to fix that. And then allocate excess cash flow and prioritize investments. Okay, so there is excess cash flow. So with what they're doing right now, this is what I see. Okay, they filled out their information, what their lifestyle expenses are, what their fixed expenses are, how much they contribute to their investment accounts. Okay, and this is what I see. They have a surplus. They're going to get a surplus each year, roughly around, say, $40,000 per year, right? And when I spoke to them, they're like, yeah, that sounds, it may sound a bit high. I don't think we have that much. We just don't know where it's going. Okay, it doesn't feel like we have that much left over. Okay, so of course, a lot of people tend to underestimate what they spend. Okay, that's cool. And that's why it's really important to make sure you're allocating your money properly so that, and not just that, just clean up your finances so that you know where everything is going. Because any excess cash flow, and this, any excess cash flow in your checking accounts, you're probably just going to spend it. Okay. You may feel like, oh, I feel so, maybe you feel like, yeah, like I've earned this. I'm putting away money in my RSPs randomly, doing it at work. I'm just going to go ahead and spend this. Okay. But then at the end of the day, once you spend it, you're like, where did my money go? I don't feel rich. I feel like I don't, and you look at your accounts, it's like, what's happening, right? So this is why it's very important to look at any surplus that you have, okay, after the taxes that you paid, any contributions you have towards your registered accounts, towards your investments, what you're left with, so that now we can properly allocate any excess towards your future goals. Okay, and that could even be paying down your mortgage faster, investing in your retirement, maybe getting ready to buy a new property, whatever it is that you want to do. Okay, you want to just know what's happening with your money. So the new strategy with Betty and Frank, okay, they're going to refinance their mortgage to include their car loan, okay, because their car loan is 5%, their mortgage rate is just under 2% right now. And in this environment where we're anticipating an increase in rates, think about if it's worth it to refinance and lock in a mortgage rate now. So maybe your mortgage is due for renewal next year, okay, or in the next 9 months, who knows, right? But we're in an environment where interest rates are going up. So that's something to think about. So what they're going to do is they're going to refinance their mortgage to include their car loan. They're going to convert bad debt to good debt, okay, by monetizing their mortgage. Okay, that means they're going to invest their equity into assets that produce income. So briefly, I'll just talk about this quickly. What's happening with your equity in your home? What do you think people do? Well, a lot of people, from what I've seen, they tend to take out a HELOC, a home equity line of credit, and then they're going to do stuff with it. They're like, oh my gosh, I'm just going to borrow against my equity and do stuff like renovations is a big one, right? So here's the thing. Renovations is, you can argue that it's an investment into a property, but it's not producing income as we speak, right? Yeah, you're using it for your house in hopes that it's going to increase the value of your home, but home renovations alone is not a main and primary factor in increasing the value of your home. Okay, you can have a really crappy home, do nothing with it, and it can go up in value. Okay, likewise, you can have a very beautiful home, dump a lot of money into renovations, and the value of your home may not go down. Okay, go up. It's a result of supply and demand and what's happening in the marketplace, right? So obviously very location dependent. So I would say pouring money into renovations, taking out a HELOC, that's an expense, okay? Because you're putting that money in towards something that's not producing income. So if you monetize your equity by investing it into assets that produce income, okay, any interest expense, any interest that is being used to invest in assets, anything that produces income, okay, it could be a property, it could be in stocks, it could be in just any assets that produce income, that will be a tax deduction against your income. Okay, so there are so many strategies around this, but that is just the gist of it. Okay, so this is, I call this rich people strategy, and if this is something you're interested in, we're going to have a talk. Okay, so this is quite an advanced strategy. It's not for everyone. Once you implement this and you do it properly, you will see your net worth just skyrocket. Like it's just like it can add hundreds of thousands of dollars to your net worth, to your retirement. It's such an effective strategy. Okay, but again, it's not for everyone. And if you're interested in this, let me know in the comment box below, shoot me a message, okay, and we can discuss how we can incorporate this into your plan. So what they're going to also do is they're going to increase their monthly investments into their RSPs, okay, because we want to bring down Betty's taxes, okay, and she's going to base on top of what she's doing right now, just increase it by $2,000 a month more for Betty and $2,000 per month for Frank. Okay, this is spousal RSP because we want to even out their investment accounts by the time they retire. So this is what they're going to do when it comes to their RSP contributions. Okay, so they're also going to adjust their portfolio because some of their investments are in some very high portfolio killing funds. Okay, so low cost ETFs. They're going to invest in alternative assets. Okay, so assets that are not correlated to the stock markets. Okay, I know it could be tempting to just want to invest everything in the stock markets, but no, there are other investments out there, and you want to make sure that your overall portfolio, okay, that doesn't just include stock markets, that it's diversified. Okay, it could be an income producing property from it could be real estate, it could be businesses, it could be art, it could be wine. There's a lot of alternative assets out there. Okay, so this would be very key for them and a big part of their wealth strategy. And then any tax refunds that they're going to get, they're going to use to pay down their mortgage. Okay, this is how they're going to accelerate their mortgage payments, any tax deductions that they get. Okay, and they're going to be deductions not reflected in their paychecks because they're executing on the rich people strategy. It's not reflected in their paychecks, so they're going to be getting a refund, okay, on top of anything else that they could potentially be getting from investing in their RSPs. Okay, so they can use the tax refund their tax refunds to pay down their mortgage. And as a result, they're going to free up their cash flow by $267 per month by refinancing their car loan, okay, under their mortgage, which has a lower interest rate than the car loan. And again, that $267, they could have used that to pay down their mortgage, but they're not going to do that. They're going to invest it instead. They've converted bad debt to good debt because the car loan, which is now under their mortgage, and they're monetizing their equity, okay, that debt is now tax deductible. And as a result of that, okay, they're going to see reduction of taxes around $90,000 over the next 20 years, okay, or on average, almost $4,500 per year. And because they're, beefing up their investments, freeing up cash flow, investing all of that, okay, and saving, money on interest costs, they're going to see their net worth increase by 57% by the time Frank retires. He's going to retire first. Okay, so they're going from $2.5 million to $4 million. Okay, so it's an extra $1.5 million. They're going to have more balanced RSP accounts, registered accounts between Betty and Frank. So making sure that when they're retired, they're going to be in relatively equal tax brackets, because when they're drawing down, they're not going to solely rely on one person to be drawing money down from. So this is what it looks like. This is their old plan. And this is just their overall net worth. So they're going from $2.5 million to almost pretty much $4 million under the new plan. And when we split that up, okay, when we break down the almost $2.2 million right here in their investment assets, not including their home, we see that Betty's going to have around 1.2 million and Frank will have just under 1 million. So a relatively more even split in their investment accounts. So let's just say they are drawing down $100,000 per year during their retirement. Betty can draw down 50K, Frank can draw down 50K. Okay, that puts them down into much lower tax brackets, as opposed to, Betty drawing down $100,000 and Frank not drawing down anything from his account. From his account, Betty's going to be in the $100,000 tax bracket. Okay, so that's why having an even net worth split is important for retirement, for when two people are retiring together. So as a result, okay, in addition to the above, they're going to pay off their mortgage faster by 8 years. And again, by the time Frank retires, they will have 2.2 million in liquid assets, so 4 million in assets. And by the time Betty retires, because she's retiring after, okay, 4 years after Frank, they will have 5 million in assets, okay, of which 2.9 million is in liquid assets. Okay, so, and I've also added a dedicated vacation fund, okay, of 10K per year for them, okay, because with this plan, I'm helping them allocate their excess. Okay, so no surplus, okay, no deficit either. Their surplus expenses right here that you're seeing, that's their vacation fund. Okay, so it's like, okay, they could do whatever they want with it. They don't want to go on vacation, fine. They want to do something else, they could do whatever they want. They want to buy some extra TVs, cool, right? They could do whatever they want with that. And their surplus savings, okay, this amount is being invested in alternative assets because they're already putting a lot of money towards the stock markets, okay, these investment assets. They want to make sure they diversify their overall portfolio, making sure it's not just in the stock markets. Okay, so this is Betty and Frank's plan. If this is something that you need help with reducing your taxes, you want to see what you're on track for, you want to increase your net worth by the time you retire, you want to increase your net worth now, you want to know what's happening with your finances, let me know. Shoot me a message below. If you're watching this video, shoot me a message below. Reply to my email if you're seeing this through my emails. But I definitely want to help you plan out your finances. If you need a CFO, okay, because all of this stuff, all this financial planning, it's like basically having a CFO in the back of your pocket. Okay, I want to help you save a lot more money, retain a lot of money, especially when it comes to taxes. Because once you pay those taxes, that's it. It's gone forever. Okay, you're not gonna be getting that money back. So it's really important to be very proactive on that part, because another year passes by, another year passes by. Okay, you're just paying more and more taxes. You're not getting that money back. And then, of course, when it comes to investing, another year goes by, years go by, you don't get that time back. Okay, so it's really critical that you take the time, you take action now to make sure that your money is working for you. And biggest thing is, the money is not going to waste. It's not going toward taxes that you don't need to be paying. You get to retain that.